Here's a closing bell on Wall Street.
There is your closing bell on this hump day. Stocks ending the day on a downward note. Not a whole lot of action, as you can see. The Dow down just 28 points, the S&P down about 12, and the Nasdaq barely slipping to the downside 9 points. Not a whole lot of reaction to the Fed minutes. For a closer look at the broader markets, let's bring in Eric Freedman, U.S. Bank Asset Management CIO, and Hugh Roberts, Quant Insight Head of Analytics. Good to see you both. Eric, let's start with you. Any takeaway from the Fed minutes, or do you expect tighter, longer? Nothing's really changed in the dynamics here.
Yeah, I think it's a story that we've heard from the Fed, really most specifically post-Jackson Hole, which is rates higher and higher for longer. I think that was really the key message coming out of this set of minutes. I think the key thing for us as we think about the tail end of this year is not so much what happens next meeting, but more what does it look like for the Fed in the first quarter of next year. By that point, we expect to have a little bit of guidance from companies, which should be a little more sobered and perhaps a bit more tepid than what we may hear right now. So our viewpoint is the bar is pretty high for the Fed to come off its current rate path for this year. But if we get into the first quarter of next year with some downbeat company guidance, I think the Fed may start to waver at least a little bit.
And Hugh, as you look at the Fed minutes and also some of these data points that you know that the Fed is watching and really looking for this sustained inflation to start going down, what is your outlook?
Yeah, I would largely echo Eric's comment. First up, I think this year and the immediate, next couple of meetings are pretty much locked in. Really, 2023 and the outlook there is more important. I guess if we're trying to look a wee bit further ahead, I think the comments from Deputy Chair Brainard have been probably the most interesting because the messaging has been consistent. It's been about tightening financial conditions. That's been true all year. And as Eric said, it went up a gear after Jackson Hole. Brainard appears to be the one who is just flagging the fact that overseas markets are seeing stress. We've seen obviously intervention in dollar yen. We're all aware of the shenanigans going on here in the UK after the mini budget a few weeks back. The whole kind of move fast and break things. I think in the States you're used to looking at things like inverted yield curves or credit spreads as the things that might domestically be the things that break. But actually it's looking like it's international stuff that's breaking first. And Brainard seems to be flagging that up a little bit. So very early days yet. It's not obvious she's got a consensus at all, but she's the one potential outlier as things currently stand.
Eric, what do you think this means just in terms of the pricing activity that we're going to see between now and year end? Are we going to remain volatile, or is more of that risk to the downside, do you think, from these levels?
We think probably a little more risk to the downside. And I would just tip my cap to Hugh and their firm. They do great work on this topic specifically, but just in terms of our read on things, we say really a couple of things at work. Number one is that we think we're largely in sync with the Fed's most recent thoughts regarding the forward state of the curve. In other words, we think the market is really in tune with what the Fed is thinking with respect to interest rate hikes. That's really the first repricing that we've had. You cover this as a team very well in the last segment. And we think what's next is the slowdown, almost the lagged impact of higher rates, still elevated fuel costs, still elevated shelter costs. We think that's going to start to really weigh in on margins. And so we do think there's probably a little more downside. We wouldn't be abandoning ships, if you will, right now, but we do think that in terms of risk to the equity market, we'd still be leaning a bit more defensive. As you pointed out, utilities and infrastructure, those have been areas that we've actually been fairly constructive on. They've been, we think, unduly hit in recent days. Those are getting more attractive. We'd stick around in energy as well. Those would be our top ideas right now.
Hugh, you say the latest down move has not been a function of macro fundamentals. What are you seeing?
Well, it's more the fact that we're being uber tactical here, to be fair. So, the primary trend throughout 2022 has been that macro conditions for US equity markets have got worse. And that's largely a function of what we talked about just now, i.e. tighter financial conditions, and in particular the move in real yields and the move in credit spreads. What's interesting from a very short-term perspective is that this latest downtrade, and I'm talking in the last week now, our model value has actually flatlined, so that this very latest down move has been less justified by macro fundamentals than for much of the bear market price action of the last 9-10 months. So if you are in a kind of repeat of the summer, potential for a bear market squeeze, looking at positioning, looking at beaten up sentiment. I saw an interesting tweet today about insider buying picking up. That tends to get people interested when, CEOs are buying their own stocks. If you're thinking there's scope for a bit of a tactical squeeze within the context of the primary bear market, then what we're seeing at the moment actually is that S&P is around 6% cheap to our model value, because macro conditions have kind of stabilized at the lows, and this latest sell-off has gone a little bit further. So still agree with the primary bearish dynamic that's been espoused, but there may be some hope for a little bit of a bear market squeeze.
And Eric, some of the clients that you speak to, what lens are you suggesting that they really view this period through?
Yeah, it's a great question. I think that, for those that have capital that they need in the, let's call it the next 3 to 6 months, we think that, a great place to be is in very short duration fixed income. For a long time, we just haven't been paid, Rachelle, to be involved whatsoever in that part of the curve. Not to say that there isn't some potential price risk, but just as you hit in the earlier segment, if you're looking at corporate bonds that are spitting out 5.5%, 6% yields, not a bad spot to be in very, very short maturities. I do think that for those clients that have the ability to kind of piece into stuff, we would not be aggressively involved in technology and consumer discretionary right now. We do think that the supply-demand imbalance is still skewed the wrong way for technology in the immediate term. But again, we do think that there's likely to be some rationalization towards the middle to the second half of next year for longer term investors. So our viewpoint has been, take what you're given in this market. Don't trade the market that you want, trade the market that you have. And so grabbing some yield up front makes sense. We do think that there's a time to, again, reconcile the second half of next year. We're just not there quite yet.
And Hugh, one of the challenges in this market now is a strong dollar. That, of course, is being felt on a global scale. We did get the earnings out from Pepsi this morning that were actually better than expected. Some were wondering whether or not, how big of a threat that strong dollar would be to a name like Pepsi. What do you think today's results really tell us just about what we can expect this earnings season?
Well, from a macro perspective, I think the Pepsi earnings were bad news from the Fed's policymaking perspective, because it basically showed that they have pricing power and that they're going to increase margins. And that's not good for the Fed, who want to see demand slow down, obviously. More broadly, I agree totally that the strength of the dollar is going to be a key issue for this particular earnings season. On our analysis, we have the ability to break down patterns between, say, sectors and the strength of the dollar. And it's the independent pattern where we're able to strip out the isolated impact of the dollar on different assets. And what stands out on our analysis at the moment is that if you look at the likes of energy, either XLE, OIH, XOP, they're all comparatively indifferent to the dollar. It's not really a big driver of price action in the energy ETFs at the moment, but it's technology that is most vulnerable. And that's true for XLK. It is true for something like consumer discretionary, where, of course, Amazon and Tesla, I think, are nearly 50% of that sector. And it's especially true for something like SOX, the semiconductor ETF. So I think that's probably where, on our analysis, that's where potentially the most pain is going to be felt.